Hey guys, welcome back to the channel. We talk about saving money, investing money, different ways to save money, invest money, but really the end goal is financial independence, right? You want to stop that 9 to 5 and you want to travel or you want to buy nice things, have nice things, whatever it is that you want to do. One of the things we haven't really talked about yet is taxes and how big of a role they honestly play. Because let's be honest, it's pretty big. Big role. So, because when you dream about financial independence, you might not consider how big of a role taxes can play, right? Well, there are some tax moves that we can recommend for those who want to walk the path to financial independence, right? There are a lot of uncertainties on the road and stuff like that, but you can't know, what rate of return your investments will earn over the coming decades, and you certainly don't know exactly how long you'll live. So, as an old cliche goes, right? The only certainties in life are death and taxes. So, what can we control? Well, your tax bill is definitely something you can control, right? I would say try not to worry about the things you can't control, right? And that might be easier said than done, but try. Taxes are one variable over which we have some control, right? We can't control how the government changes the tax code, but we can plan our lives and investments in ways that will affect how much tax we owe, both now and in the future. So, strategic tax planning isn't just for the wealthy, but unfortunately, it's true that billionaires seem to benefit most from it. But, in fact, there are some simple things nearly everyone can do that may end up saving you tens of thousands of dollars in taxes or more over your lifetime. So, we're going to start with some of the tax things that are available to most people. Right? Some of the strategies that's going to come later are really only going to be relevant once you've taken advantage of some of the basics and earn, say a certain amount of income. So, the first thing we're going to talk about is taking advantage of retirement accounts, right? Because I'm sure you're just tired of hearing about how important it is to save for retirement. Use a 401k or an IRA. Well, there's a reason that people like me talk about them over and over and over, right? These accounts represent a huge gift from Uncle Sam to taxpayers, right? In a traditional IRA or 401k, contributions are tax free. Then, your earnings grow tax deferred until retirement. Every year, investments generate dividends, interest, and if you sell investments at a profit, capital gains. In a traditional taxable investment account, you pay taxes on that investment income every year. With a traditional 401k or IRA, you can invest pre tax dollars now, and you don't have to pay taxes on any of that investment income until you begin withdrawing money in retirement. With a Roth IRA, you must invest after tax dollars now, but all the investment income you earn over the years is tax free. With either type of account, the money you save by not paying taxes on investment income each year can continue to compound growth. The earlier you start putting money in these accounts, the more you're going to save. So, let's look at an example. Let's say a 30-year-old in the 25% tax bracket contributes 5 grand every year to an IRA for 30 years, right? Say then retires at 65, right? Now this person is going to earn an average of say 6% interest annually, right? So at retirement, the IRA is worth about $630,000 before taxes. If the money had been invested in a taxable account, it would be worth only about $340,000. That's a big difference. But since it's a traditional IRA, she still has to pay taxes on withdrawals. Now, after paying taxes on the IRA, she's left with 473,000 and some change, right? That's still a savings of like 140 grand over investing in a taxable account. Everybody needs to put as much money as they can afford into these kinds of retirement accounts. Not only is it smart planning for your future, it'll save you it'll save you quite a bit on your taxes. Um, you know, if you need help managing your 401k or IRA, you can always, try to find someone, an advisor or something like that can help you manage your account for you or show you how to do it, right? And take into consideration, your retirement goals, rebalance your portfolio as you need and stuff like that. So, the next thing, an HSA or an FSA, right? Because flexible spending arrangements, or FSAs, and health savings accounts, HSAs, are accounts that allow you to use tax free dollars for medical expenses. The largest difference between them is that FSAs are owned by employers, while HSAs are controlled by individuals. HSAs are, in my opinion, usually the better option, right? But to qualify for an HSA, you need to be enrolled in a qualifying high deductible health plan. So, what is an HSA? Well, I have a video on HSAs, but we'll go over it real quick right here. So, you can contribute up to about $3,500 pre-tax dollars per year, right, to an HSA. These funds can be withdrawn at any time to pay for qualifying medical expenses tax-free. There's no need to use or lose HSA dollars, as the funds roll over every year. So, like traditional IRAs and 401ks, early withdrawals that aren't used for medical expenses are subject to a 20% penalty and income taxes. After you turn 65, though, you can withdraw HSA funds for any purchase, right? Not just medical expenses, penalty free. You will owe income taxes on withdrawals not used for medical expenses, though, right? HSAs are great for saving on medical expenses now, but they're even better if you invest dollars in HSAs and let them grow to pay for medical expenses later in life. If you invest the funds in your HSA, the money is going to grow tax free just like an IRA. But when you withdraw money later in life to pay for medical expenses, you pay no taxes at all on both the dollars you contributed and your earnings. No IRA is truly tax free. With a traditional IRA, you pay taxes on withdrawals, but not deposits. With a Roth IRA, you pay taxes on deposits, but not withdrawals. When used for medical expenses, you don't have to pay any taxes on the money you put into or take out of an HSA. Okay, well, what about FSAs, right? What's a flexible spending arrangement? All right. FSAs are basically, they're another type of account that provides tax-free dollars for medical expenses. FSAs are set up by your employer and go away when you change jobs unless you contribute your health insurance through Cobra, right? They have lower maximums. I think it's like $2,600 for individuals and a little over $5,000 for households. So a little tricky here, right, with FSAs, is they are a use it or lose it account. You can roll over up to $400-$500 every year, but all the other funds in the FSA expire at the end of the year with a 2.5 month grace period, right? So this can lead employees to scramble at year end to line up routine doctor appointments, stock up on prescriptions or qualifying over the counter purchases. And since you can't usually have access to both an HSA and an FSA at the same time, take advantage of either if you can. If you find yourself in the unusual position of having the option between the two, again, I recommend the HSA. So another thing we want to do is avoid tax penalties and interest, right? Okay. It should go without saying, right? But pay your taxes, right? Equally as important, do not ignore or procrastinate on any tax problems that arise. Right? The IRS is going to charge you penalties and interest anytime you don't pay enough tax by the deadline. This can occur for lots of reasons, but most commonly it's going to happen, say you don't have enough taxes withheld from your paycheck, which is a W-4 error. You earn money through a business or self-employment and do not make or underpay quarterly estimated payments. You file a tax extension and fail to pay any estimated amount due, right? An extension to file is not an extension to pay, right? You simply pay late. The longer you go with a balance due to the IRS, the more interest accrues. And a tax debt is the worst kind of debt to have, right? Because the IRS has the power to garnish your wages, seize future tax refunds, attach your assets, and even reduce Social Security benefits when you retire. Another thing to talk about is going to be donate to charities, but we want to do it smartly, right? Because you probably know that donations to qualified charities are tax deductible. But you can only claim the tax benefits of charitable donations if it makes sense for you to itemize your deductions. With a standard deduction standing at $12,000 for individuals and $24,000 for couples, a minority of taxpayers itemize. Does this mean charitable donations can't help you if you don't itemize? Of course not. If you do itemize deductions, cash charitable donations reduce your taxable income dollar for dollar up to 60% of your income. So go ahead and make them every year. You can also donate appreciated stock to charity, and that can be a win-win, right? The charity gets their donation, and you get a tax deduction equal to the stock's fair market value, right? Not its cost basis. You can deduct up to 30% of your income this way. If you don't regularly exceed the itemized deduction amount, you can still make charitable donations work for you by either, say, grouping your deductions in certain years, or even better, making occasional large gifts to a donor advised fund. So let's talk about that donor advised funds, right? It's just going to be an investment account to which contributions are tax deductible in the year you make them. You can contribute cash, appreciate assets, or investments held more than a year. Then you can make donations from the fund whenever you want. Donor advised funds are a great way to give because you can give your money a chance to grow and yourself years to choose the best way and time to allocate your charitable funds. So let's go over an example. Let's say you give $1,000 to a charity a year on average. Your total tax deductions, not including your donations, total about 10 grand. Even adding the donation will keep you under the 12,000 individual standard deduction. So, rather than donating 1,000 every year, let's say you set aside $1,000 in a savings account every year for 5 years. In the 5th year, you put that money into a donor advised fund and add 5,000 to your itemized deductions. This gets you a 3,000 additional deduction, 15,000 itemized, 12,000 standard in your taxes that year, right? So another thing you want to do, be tax savvy, like depending on where you live, because each city, state, there's different tax codes and stuff like that. Because if you're serious about paying fewer taxes, you want to consider living in a low tax state. When it comes to state and local taxes, not all states are the same, right? They're everywhere. According to data from the Tax Policy Center, the difference in tax burden between the state with the highest burden, which is going to be New York, and the state with the lowest burden, which is Alaska, is a little over 7%. If you live in New York, you might be thinking about what you could do with an extra 7% of your income, huh? A handful of tax states, though, attract an outsized share of entrepreneurs and other wealthy residents because of their 0% income tax rate. Although, personally, I can't imagine moving across the country solely for tax purposes. But I know a couple people who have moved, to save money on taxes. There is an argument to be made that a lifetime of state tax payments invested is an amount of money too significant to ignore. So, again, let's take an example. Let's say you earn about $100,000 a year for 50 years. Not that you have to work 50 years, right? But, let's just say $100,000 a year for 50 years. Over those years, you may pay an average state income tax rate of 5%. If you could skip the tax payments and instead invest that money in the stock market at an average return of 7%, be about $2 million, right? See? Seeing like those numbers, I mean, it's like, hold on a second, there might be something to this. Another thing you want to do is be a tax efficient investor. When you own stocks and bonds outside of a retirement account, like a 401k or IRA, you will owe taxes on the interest, dividends, and capital gains earned from those investments. Although you do not need to pay capital gain taxes until you sell the investment at a profit, most investments will pay you interest and dividends each year. Whether you spend that money or reinvest it, you will owe taxes on it. There are two schools of thought when it comes to taxes and investing. Most investors try to minimize the tax consequences of their investments whenever possible. Some are going to argue that taxes should take the back seat to whatever investing strategy will get the best return. Honestly, it might be somewhere down the middle, right? But whatever your view is, some of the ways to reduce your taxes on investments they just make sense, right? So, another thing, take credit investment losses, right? If you own investments, stocks and bonds or even real estate, and sell them at a loss, you can write off your losses. This can be an incentive to exit a losing investment if you suspect it's never going to recover its value. Okay, but this tactic can also be used strategically as a part of routine portfolio reallocation. You might have heard this before, called tax loss harvesting, right? You can deduct up to about $3,000 per year for stock investment losses, but you can carry forward losses to future tax years. So let's take an example. If you had a $9,000 capital loss, you could deduct $3,000 a year for 3 years. You may also be able to deduct up to $25,000 of rental real estate losses if your adjusted gross income is about $100,000 or less, or a portion of that amount if your adjusted gross income is up to $150,000. Another thing is bonds and dividend stocks will generate taxable investment income every year. Growth stocks that do not pay dividends, however, they don't. If you have a taxable investment account and want to own both kinds of investments in your portfolio, put the income generating investments in your IRA or 401k and buy non dividend stocks with your taxable account. Okay. Another thing, a lot of people talk about ETFs and mutual funds, index funds, all this stuff, right? Use ETFs instead of mutual funds, right? Because ETFs can be more tax efficient than traditional mutual funds. Both can generate capital gains and dividends, but ETFs are structured in a way that minimizes tax liability for the investor, okay? Another thing you can do is invest in municipal bonds. Because if you want to pay even fewer taxes on your investment income, consider tax exempt municipal bonds, right? Because the earnings from them are exempt from federal income taxes. The government makes interest on these bonds tax free to encourage investment in local and state projects. These bonds, sometimes called munis, yield less than corporate bonds before taxes, but are competitive and sometimes better when you compare after tax returns. Okay, so one of the big things that I would say is to use a business to reduce your tax bill. Right? Starting a business takes you to the next level of tax breaks. You don't even need to create an entity like an LLC. If you earn money outside of a salary, right, your W 2, you can call yourself a sole proprietor. To deduct business expenses and take advantage of other business tax breaks, you'll need to do two things. Keep an accounting of your business income and expenses separate from your personal accounting. Then you need to file a Schedule C with your tax returns. In addition to deducting business expenses and, potentially, the use of part of your home as an office, you can also take advantage of some special retirement savings accounts. The solo 401k and SEP IRA both allow much higher contributions than traditional 401ks and IRAs. So for 2020, you can contribute up to the lesser of about $57,000 or 25% of operating profits to a SEP IRA. Otherwise, the SEP works like a traditional IRA. Money in is tax deductible and your money grows tax deferred until retirement, right? So let's wrap this up and summarize everything. Nobody wants to pay more taxes than they have to. Everybody should take their taxes seriously and seek professional advice if and when you need it. If you're intent on achieving financial independence as quickly as possible, reducing taxes is going to be a large part of your plan, right? Some of these methods are just going to be, they're going to help a lot. As you begin implementing them, though, just remember to not let your life be dictated by paying as little tax as possible. At a certain point, the law of diminishing, returns is gonna apply, right? There are probably uses of time that will be more profitable in the long run, right? I really hope you guys got some good information out of this. It helps you, figure out like things you can do, or maybe you've been thinking about doing them, and now you're like, okay, that makes sense. I really should get on it, right? So I hope you guys enjoyed the video. If you liked it, go ahead, subscribe to the channel, give it a thumbs up, and I'll see you guys in the next one. Y'all be safe.